assessee. In computing total income of the assessee, here the Supreme Court said it has to be read as total income of the undertaking. So that is why, to negate the judgment of the Supreme Court, they have said total income of the assessee and not total income of the undertaking. So you have to deduct it in computing the total income of the assessee. And this is now to be treated like a chapter 6A deduction. At that stage you will allow the deduction, and it cannot result in a loss.
Right.
Earlier, suppose the 10A, as per the Supreme Court interpretation, you deduct at the stage when you compute profits and gains of business. Now, if your profits and gains of business on an aggregate basis is less than the deduction admissible under 10A for the eligible unit, it will result in a business loss. That can be set off against other income, or it can be carried forward.
Correct.
So effectively you are carrying forward your 10A deduction which was not absorbed against other income.
Right.
Now this provides that you cannot have a situation that your deduction under 10AA will exceed your total income.
That's right. That's right.
So this will now be like a chapter 6A deduction.
So after GTI,
Yes.
from GTI we reduce this like a,
Right. Like a chapter 6A.
in addition to chapter 6A,
in
another
addition to
deduction is
chapter
there.
6A.
One more thing which we would want to point out is that no similar amendment has been made in section 10A and 10B.
No, 10A I think we were just checking up. You see 10A with the sunset clause,
Yes.
10A is over now.
Right. But there could be
No, they said
there
no
could be
deduction.
litigation in relation to earlier assessment years which are
No,
still
earlier
pending.
assessment they obviously
So-
will not be governed by this.
No, so what I'm saying is that Yokogawa would continue to apply in relation to 10A and 10B,
10B, yeah.
where the litigation is pending on this
Yes.
issue.
Yes, certainly. Yep.
Here one more.
There's one
Yeah.
question.
Can anyways be argued that there we are limiting to the export turnover of the undertaking as well as the total turnover of the undertaking, profits also limiting. But then when it comes to computation mechanism, then we are saying just restricting it to the total income, whereas the formulas and everything provides in the act itself that it is undertaking specific.
No,
So
see, the computation is still with reference to the undertaking. You will determine your quantum of eligible deduction based on this formula, which has the profit of the undertaking, export turnover of the undertaking, total turnover of the undertaking. You come to a certain number. But this will be set off against the total income of the assessee. So if there are inefficient units which have made a loss, it will eat into the deduction admissible to this eligible unit. Otherwise, on a standalone basis, the eligible unit is entitled to so much deduction, which is based on its own working, unaffected by the losses. But for purposes of calculating the total income of the assessee, you have to aggregate the undertaking, the eligible undertaking profit and the profit or losses of the other undertaking.
Another issue is whether this amendment is retrospective or not, considering that the language used is that for the clarification of doubts. So usually when the language is clarification of doubt, it is considered to be a clarificatory amendment and having retrospective operation. But that need not necessarily be the case in all situations. You have to see the intent and purport of the amendment, how substantial it is, and whether it affects the vested rights of an assessee. If the vested rights of an assessee are affected, then merely because the language uses for clarification of doubt, it would not automatically result in it being considered as a retrospective amendment. It could still be prospective. And there are decisions to that effect. One of them has been referred here, and there are several other decisions as well. So I would think that it is a substantive amendment because it in a way nullifies the decision of the Supreme Court in case of Yokogawa. So, and it results in higher tax liability in the case of assessees. So it fastens additional liability which was not there earlier. And in that sense, it's a substantive amendment and not a procedural or a clarificatory amendment. And it should have prospective operation, but you cannot rule out litigation. And department may say that it's retrospective. In relation to housing projects under section 80 IBA, 100% deduction is allowed in relation to certain projects depending upon the area. The deduction earlier was with reference to built up area, and now the built up area has been substituted with carpet area. So to give fillip to small category houses. And also there was a section that in case of houses which are built in the metropolitans and an area within 25 kilometers of metropolitan cities would also fall within the ambit of this provision, 80IB. So there was a restriction that has been taken away. So even if you were to build slightly bigger houses outside the metropolitan, it would still qualify for deduction under section 80IBA. Sorry? No, within metro is the same. Within metro, the only change is that the built-up area is substituted by carpet area. But for yes, yeah, that's right. That's right. Yes, carpet area has been defined. Yes, it has been defined with reference to another act. No,
Yes,
they have referred to,
as defined in so and so act. Yes.
so they have referred to another act. So the carpet area defined in that act would have effect here as well. Also, presently the period for completion of the project
Carpet area
specified.
as defined in section. You can read out this. Carpet area 20 carpet area is defined.
Yeah, carpet area shall have the same meaning as assigned to it in clause K of section 2 of Real Estate Regulation and Development Act 2016. Yeah. Yeah. Also, the time limit for completion of this project has been extended from 3 years to 5 years. So this is a welcome amendment. In relation to the deduction which is available to profit-linked deduction which is available to startups for 3 consecutive years, it was available in 3 consecutive years out of first 5 years. Now 5 years has been extended to 7 years. So at the option of the assessee, it could be 3 consecutive years within the first 7 years that they can get this deduction. Now I come to certain amendments which have been made in relation to minimum alternate tax. So the finance minister mentioned in his speech that maybe there is a strong case for abolition of MAT, but he did not do it. He said that instead of that, what I'll do is that I'll extend the MAT credit period, which is presently 10 years, to 15 years. So that is the amendment under 115JA, that MAT credit would now be available for a period of 15 years as against 10 years earlier. No, you see, if the MAT period in relation to MAT credit period in relation to earlier assessment has already expired before this provision gets triggered, then in my opinion you would not be entitled. However, if you are, let's say, in the 9th year and the 10th year is going to expire next year, then it gets a fresh lease of life and you will be entitled to credit for 15 years. But yes, where it is already lapsed, then that would not get a fresh lease of life. Yes. No, those situations according to me would not get covered. Yes.
10 years is elapsed, but at the time of the credit itself, the 15 years has not gone.
Right.
So what will be the position in that case? You mean to say it will not be allowed? It's already lapsed.
It is already lapsed. That
There is no provision of lapsing as such.
no, you have to.
I would not have been allowed in the 10th year.
Yes. Right.
But as on the year of the claim of my MAT credit, the 15 years is applicable, the provision of the 15 years is applicable.
Right.
So why should not be allowed? Why should not it be allowed? Because one has to observe the provision only in the year of credit being claimed.
Right.
So that is my 11th year or 14th year.
Mm-hmm.
So in the 14th year, the relevant provision has to be observed.
Mm-hmm.
In that, the 15 years credit was allowed.
Mm-hmm.
And my 15 years is not elapsed.
Mm-hmm.
So in my opinion, it should be allowed.
No, it has to be seen with reference to the year in which you were first entitled to the MAT credit, and it was entitled. You were entitled to.
Now, point is it a carry forward provision or an adjustment provision?
Adjustment provision.
It's not a carry forward provision.
No, it is.
It's an adjust.
It is. 115
You see, it
JJA3.
115JAA3, the amount of tax credit determined under subsection 2 shall be carried forward and set off in accordance with provisions of subsections 4 and 5, but such carry forward shall not be allowed beyond the 5th assessment year, immediately succeeding the assessment year in which tax credit becomes allowable. And then this 5 has become 10. So therefore it is a carry forward provision. carry forward and set off. So if it has already lapsed before coming into force of this amendment, it will stand exhausted.
Yes, yes.
My 10th year is
Yes.
1st March 2017.
Right.
So it will be lapse.
Yes, it will.
It will be carried forward or it will be lapse?
It is applicable 1/4/2018.
This is amendment is applicable from assessment year 17-18, no? Or 18-19?
18/19. 18/19.
18.
No, it is lapsing on 31/3/2017.
31st March. Yeah.
17 it is available, you are saying.
Huh.
No, it is going to lapse.
Last year,
Last
Last
year.
March 17 it was available.
Yes.
If in case there were profits.
Yes.
So they did have profits. So,
No, March 17 I am adjusting it.
no, so that it still remains.
Yes.
No, that would lapse because 10 years are lapsing on 31/3/2017.
Okay.
Yeah.
So it is applicable from 1st April.
Merely because the bill has been announced prior to 31/3/2017 would not mean that you will count 10 years from that point of time. It is with reference to assessment year.
Okay.
As I said, the carry forward, if you see a normal return form for MAT companies, since we are one, we don't fill up the MAT carried forward what is paid in advance. What is only is the normal loss carried forward is shown in the disclosure columns under the normal return of income applicable to companies.
Right.
So then it lies within the certificate as you obtain from a chartered accountant under 288.
Right.
So then where is this carried forward sanctity coming in from?
That is from the
No,
statute.
but it's in the statute, but
Yep.
the sanctity
You
is
don't
not
have to-
observed in the return also.
It may not be necessary. In fact, Supreme Court has also said that you don't have to go really by the return of income. You have to go by the provisions of the statute. That's very clear.
Okay.
In fact, that was in the context of section. Is there in the return?
It will have to be.
No, carry forward is saying. Carry forward.
Of the MAT times.
That is also year-wise. Year-wise. For each year,
Yes, sir.
it has to be carried.
Like you say, you have carry forward of losses.
I
There
think
is-
it'll have to be,
there-
there'll have to be an aging. There'll have to be an aging of the carry forward that you are doing.
So Sridhar's point was that in the return of income, perhaps there is no column for carry forward of like you have for losses. Then there is no column for carry forward of MAT credit. So he was saying that statute uses the word carry forward, but there is nothing in the return, which is not the case. Which is not the case. So it is there.
Then you'll have to give the real value.
Yeah, yeah. Another amendment is in relation to the foreign tax credit which is available against MAT liability, and what has now been provided is that if you are availing foreign tax credit against your MAT liability, then the excess of the foreign tax credit against the normal tax liability would not be allowed as a MAT credit. So this we have explained with reference to this illustration. So let's say there is tax liability before foreign tax credit under MAT of 120, and under normal provisions the tax liability is 80. So normally you would be entitled to carry forward 40 as MAT credit. And let's say you have foreign tax credit of 100. So 100 you are setting off against the MAT liability. So the MAT liability is 20, MAT credit amount which can be carried forward is 20. Under the normal provisions, foreign tax rate would be allowed only up to the 80 and not the entire 100. So what the provisions now says is that to the extent the foreign tax credit exceeds the tax under the normal provisions. So in this case, foreign tax credit is 100, normal tax is 80, so 20 is the balance amount. This is the excess amount. You would not get deduction of 20 under the which can be carried forward under MAT. So the amount which can be carried forward under MAT would only be 20 and not 40, because you have already got credit by way of FTC to the extent of 20, which was the differential amount. So simply put, the difference between the MAT liability and FTC is the amount which can be entitled to be carried forward, and not the difference between the MAT liability and normal provisions in this kind of a situation, because you have already got credit of foreign tax credit against the MAT liability. Sorry? So DTA does not deal with the credit. DTA only says that if any income on which you have to pay tax, then to the extent tax paid in relation to same income overseas, you will get a credit. So the mechanics, etc., are not specified in the DTA.
I think this is largely on the principle that this can't result in a refund.
Refund, yes, yes.
I think you can probably explain this in that context.
Yes, because what has happened, if you could be entitled to carry forward 40, so if you were to see foreign tax credit or limit it only to the normal tax payable, which is 80, then, and you are entitled to 40 to be carried forward as bad credit, then essentially you are getting refund of 20, which is the foreign tax credit you are also availing.
They would have restricted the foreign credit against the normal provision of tax.
That in any case, you see here in this situation, you will not get.
They have done this, but here little more benefit is there.
Here in any case, you will not get credit for more than 80 under the normal tax provision, right? But if you were to get credit of the entire amount of 40, then essentially foreign tax credit of 20 which you are availing, you could carry it forward, which would be a refund situation.
But the point is, as per the DTAs, normally the entire act is covered. Whatever is levied and whatever is not levied. When that income is forming part of the taxable income either under MAT or under the normal provision, that foreign tax should be treated at par with the with any other kind of the tax paid already.
You are getting the credit for the entire amount. You see,
they have not given, because what they have given is 100 as a credit against the liability of MAT. MAT is not the actual tax, in fact. It may be allowed to be carried forward. The tax is levied on me is 80 only, not 120. 40 is my credit, which may be availed within 15 years or whatever it is. So the entire credit of FCTs has not been given to me.
No, you see, you are only paying MAT liability of 20 because of availing credit of 100, right? So now you are wanting to carry forward that 20, which is all
That
right.
means the refund of FCT is not allowed to me. In other words, refund of FTC is not allowed to me.
Yes.
Rather, bill has done a favor to me to adjust this against the MAT.
No, that was already there.
That is available to you as a matter of right under the statute.
It is available.
So that is what I am saying.
No,
When it is
bill has-
allowed to me,
Bill has taken away 20.
no, that is what. Why they have taken 20? Then they should not have taken 20 also.
No,
Na?
they have taken back 20, not done a benefit to you.
No, that is what I am saying. Na? They should not have taken it back.
So if you see this example, your tax under normal provisions is 80 and your MAT is 120, right? So you pay tax on 120 because that is higher of the two. In a normal situation, you would have got credit of 40. That would have been carried forward. Now, irrespective of how you pay the 120, 40 would still have been allowed to you, whether you pay it in cash, advance tax. FTC is also a part of tax paid in advance. So therefore, it is something that you could claim as a matter of right. Here the government has taken away that 20.
So, no.
No, it has not caused you a benefit.
No, I'll explain. No, you see,
Yes.
yes.
Right.
So this liability, when it adjusted against the MAT, whatever consequences, because it is an advance tax otherwise, so whatever consequences, what the normal tax is there, that should be there.
You see,
What I mean to say, if this 20 rupees, which has been withdrawn is wrong, either they should say it will be adjusted against the normal provision. I am not able to understand it. Half day.
No, it has taken away your 20.
no, the reason why they have taken away 20 is because that's a tax which has been paid to the foreign government. You see, no. So because you have got a credit of this amount. Ultimately, what you are paying to the Indian government is only 20, and that is so something
No,
which has.
Rupesh, I think see it from this light, that irrespective of the manner in which you discharge the 120 is your liability under MAT. So that is your tax liability under MAT. So irrespective of how you discharge it, you would have got a credit for 40. 120 minus 80. Your MAT credit is 100. Now you have absorbed the entire MAT credit against your your FTC credit against your MAT liability. So you are paying, there is an outgo of 20. But your MAT credit is fully utilized because you have tax payable of 120. It is sufficient to absorb your FTC. So technically, irrespective of how you meet your tax liability, whether by FTC, advance tax, TDS or so on, you should have got the credit for 40.
Sir, it is like this, that if you don't get credit, don't get refund from the Indian government of any taxes which have been paid overseas.
No, there is no question of refund here.
No. So how by carrying forward the MAT credit, in a way you are seeking
No, you are
refund
not
of that
getting
20
refund.
which has been paid to the foreign government. No, what I'm saying is that if you cannot get refund, supposing you have, let's say in this kind of situation, if there was no MAT liability, okay, 80 is your normal liability, you would get credit only of 80 and not of 100. So 20 would not be refunded to you. Clear? Right? No to do views on this. Now, when you claim this credit of this extra 20 against the MAT liability, and that 20 actually has been paid to the foreign government, and you want carry forward of that 20 also, in a way, you are seeking refund of that 20 which has been paid to the foreign government, which cannot be allowed.
But it will always be, the difference between whenever it is claimed as a credit in the subsequent years, it will be again the difference between the normal provisions and the MAT.
That's right.
So I don't think it will result in a refund. So should this not be something, I don't know,
No,
maybe
not
against...
a refund.
This
It
is
may not,
akin to a refund. That's
it
what
may not physically amount to a refund, but it will be taxes paid in advance for which you will be allowed a set off if this credit was to be available. So the point that Rupesh is making, that you can in year 1 avail the FTC up to the tax liability. So 100 is absorbed. Now if you were to carry forward 40, it includes the 20 that is used as FTC. Normally, if your liability was 120 and you paid 100 by FTC, that would have been over and gone. Now the Act allows you to carry forward this difference between MAT liability and normal tax liability. So to that extent, your FTC is being carried forward. That's the point that is being made. So in effect, you are getting credit or refund in a manner of speaking for the FTC.
So not actual refund, but akin to refund, that is what is happening.
Is it, I don't know if it can be argued something in the sense that why FTC should not be equated to the normal tax and it is against the principles of natural justice to make a difference. Do you think it will be an arguable case in that sense?
No, I don't think so, because in equity, if you are under normal provisions not getting a refund of that 20, why should you be allowed to carry forward that 20 merely because you are able to set it off against your MAT liability, or MAT liability is more than the FTC? Yes.
So taking this example further, I have a query regarding, in my example, the normal tax liability is 80.
Yes.
But if I have a case where the normal tax liability was 200, and
Yes.
because of long-term losses, the normal tax liability has come down to 80. So what would be the adjustment of the credit?
Okay, this is actually outside the purview of these amendments, but because this is then whether the FTC will be limited to the income on which tax is being paid after considering carry forward or not. I am of the view that you need to take into consideration the carry forward losses, and you will be entitled to FTC only to the extent of tax paid on the income in India after setting off carry forward losses.
That would be 80 only.
Yes, that's right. Okay. Now we come to the impact of Ind AS on MAT, and this is something which is very complex. So I would not go into too much of detail, but very broadly explained and try to keep it simple to the extent possible. So after the Companies Act 2013, as you are aware, the accounting standards were notified under Section 133 of 2013 Act, and then rules were also specified, which are Companies in Indian Accounting Standard Rules 2015, which laid down the roadmap for Ind AS. The government of India had also set up a committee to look into the tax aspects or tax implication of Ind AS in relation to computation of book profit under Section 115 JB. And the committee had submitted 2 reports, and final report was submitted on 22nd December 2016, which is not in public domain, but the earlier reports are there on public domain, and comments were invited. So after taking into consideration the recommendations of the committee which was set up by the government, the amendments have been proposed in 115 JB. So very broadly, to give you a background of Ind AS, as you are aware, that now because of Ind AS, you have to move from historical basis of accounting to fair valuation basis of accounting. Now when you revalue your assets with reference to fair value, then there could be adjustments, and there could be positive, there could be negative, both kind of adjustments are there. What Ind AS provides is that in the year of transition, you need to take into consideration the impact of this fair value accounting with relation to assets, liabilities, and the amount needs to be taken to retained earnings. Retained earning is not part of the profit and loss account, statement of profit and loss account, it is part of balance sheet. Thereafter, year after year, when you do at the balance sheet date the valuation, fair valuation of your assets and liabilities, the differential or adjustment is to be made in an account called OCI, that is other comprehensive income, which is part of the statement of profit and loss account. But the entries therein are notional because they are with reference to fair value. An issue which had arisen is that whether this the OCI, that is other comprehensive income, which is part of the statement of profit and loss account, but which relates to all notional entities, whether for the purpose of book profit, you need to take the profit before OCI or after OCI. Because if it is after OCI, then you are taking into consideration essentially notional gains or notional losses. So the committee's recommendation was that it should be before OCI, subject to certain adjustments. So which has been in principle accepted, and now it has been provided that in relation, so you have to take the profit before OCI, that is other comprehensive income, subject to certain adjustments. And also in the case of retained earnings, certain amendments have been made. So we'll come to that one by one. So first I take up the adjustments which are required in relation to OCI, that is other comprehensive income, which is not the year of transition, but years subsequent to the year of transition. Insofar as year of transition is concerned, that is retained earnings. I'll come to that later. So what is provided is that in relation to OCI, the items which are included in OCI, which will never be reclassified to the statement of profit and loss account, shall be included in the computation of book profits at certain points of time which are there in this table. So this we are talking about those OCI's adjustments which would never form part of the profit and loss account, which would never get transferred from OCI. It would not be considered for book profit purposes, it would be ignored. It would be considered only in the year of disposal of the asset or realization or retirement of the asset, not in the intervening years. Similarly, gains and losses from investments in equity instruments, which are again, need to be classified at on balance sheet date with reference to fair value. There also, they would be ignored. The impact would be completely ignored for book profit purposes, and the impact would only be considered at the time of realization or disposal of retirement. Now, in relation to remeasurement of defined benefit plans, it is provided that this would be done on a year-to-year basis, and it would impact the book profit. It would be taken into consideration on a year-to-year basis for book profit. And any other item, this could be, for example, share of OCI in associates and joint ventures, this would also be done on a year-to-year basis. So, except for the first two items, which is the fair valuation done in reference to plant, property or equipment, intangible assets, and equity instruments, where you have to ignore the OCI for book profit purposes. In all other cases, the OCI adjustments would be taken into consideration for book profit purposes. It is also provided that in case of distribution of non-cash assets to shareholders in a case of demerger, the difference between the carrying value of assets and fair value, which is recorded in the profit and loss account, it would also not impact book profits because it is totally notional. And in the case of resulting company, the revaluation, if any, done by the resulting company would be ignored, and they would have to record the assets and liabilities with reference to book values. Now I come to MAT with reference to the first time adoption, that is in the year of transition. Here too, the situation is more or less the same as in the case of OCI. So insofar as retained earnings which are impacted because of revaluation surplus of PPE and intangible assets and also equity instruments, it would be ignored for MAT purposes. Other than that, whatever adjustments are there in the retained earnings, what is proposed, and which would never be reclassified to profit and loss account, it is proposed that the adjustment would be made to book profits over a period of 5 years in equal installments. So insofar as retained earnings are concerned, other than the first two items, the impact would be taken for MAT purposes over a period of 5 years. The committee has recommended 3 years, but in the legislation we have, the 5 years time has been given. all other adjustments recorded in reserves and surplus, which would otherwise never subsequently be reclassified to the profit and loss account, as I said, would be impacted, MAT would be impacted, but over a period of 5 years. Now the reference here for the first time adoption of adjustment, that has also been, sorry? Okay, all right, okay. Let me give you an example in relation to this point number 4 here, let's say accounting for leases. So presently the accounting for leases, as you know, is done on a straight line basis under the present gap. Let's take an example where you have a 6-year lease and 100 is the amount which you pay every year in relation to that lease. And there's a provision in the lease that after 3 years it would be increased, the lease rental would be increased by 10, so by 10%, let's say. So over the 6-year period, you would have paid 630. So for 100 rupees for first 3 years and 110 for the next 3 years. So 630 is the total amount. Now, as per the present gap, that is prior to Ind AS, you would spread this 630 over a period of 6 years. So 110 would go to each year. So let's say the year of transition is the year 3rd, and you have already debited in your profit and loss account 330, that is 110, 110, 110. But however, as per Ind AS, you have to consider only 300, which is the amount which is being paid. So this 330 minus 300 would go to retained earnings. Okay? Though it is debited in the profit and loss account, and in the MAT, you have taken benefit of that 110, but as per Ind AS, 300 is debited to the profit and loss account. Ultimately, that 30 goes to retained earnings. Now this 30 would never get credited to the profit and loss account, because in the remaining 3 years, you would debit your profit and loss account with 110, 110, 110. But so what happens is, in totality, what you have debited is 110 over a period of 6 years, which is 660, whereas the total amount paid is only 630. 30 has got to retained earnings, and that retained earnings would never be part of the profit and loss account. So therefore, it is now provided that this 30 which has got to retained earnings would be taxed or would be taken into consideration for MAT purposes, but over a period of 5 years. Right?
To that extent, this is shift from the old Apollo tires plus the Ind AS adjustments would now be the MAT profit.
Yeah. That's right. That's right.
Tires as adjusted by Ind AS would now be the calculation method for.
That's right. Book profit as per Ind AS, and the explanation which is given 115 JB. Yes.
That of course would apply because
yes,
there
yes.
before.
That's
also.
right. That's right.
Any other question?